Ways to invest in stocks as beginner. I am looking for high-growth stocks that have the potential to be multi-baggers and world-changing companies over the next couple of decades. I hold for the long term and rarely sell. What I look for in a company. Thread. First, I look at the company's mission statement. I am looking for a company with a mission statement that is simple, inspirational, and leaves a lot of room for optionality. Example: $AAXN, to protect life, or $SHOP, to make commerce better for everyone. Next, I look at the company's moat, or what gives it an advantage over the competition. There are multiple different kinds of moats that a company can have. 1. Network effects. A company has a strong network effect when it becomes more valuable in each additional user it adds. Example: $ETSE. As more and more people shop on ETSE's platform, more and more craftsmen are enticed to list goods on there, which draws more buyers, and so on. 2. High switching costs. A company has high switching costs when it would be difficult for users to switch away once they engage with the company. Example: $TWLO. Twilio's technology is very difficult to replicate and thus would be costly for a company to develop on their own. 3. Cost advantage. A company with a strong cost advantage has a clear leg up over new entrants. This could be through extreme scale, producing goods at a lower cost, etc. Example: $AMZN. In e-commerce, Amazon's massive scale and distribution network give them an advantage. 4. Assets. For most companies, this is simply a measure of how strong their brand is. Other assets include patents and government protection. Example: $Goog. The word Google is essentially synonymous with the Internet at this point, giving them an invaluable asset. Finally, I look to see if the company's moat is growing relative to the competition. Example: $Meli. Mercado Libre continues to be at the cutting edge of e-commerce in Latin America, even adding a payments wing to bolster its growth. After the moat, I examine the company's potential for growth, looking at multiple different factors. 1. First, I look at the company's optionality. Essentially, I am looking to see if the company has an innovative culture and the potential for new products or industries. Example: $FB. Facebook has social media platforms, WhatsApp, and is involved in VR and increasingly e-commerce. 2. Next, I want a company that is an unquestioned leader in its industry. $AAXN. The first to do what it is doing. $TMDX, and/or offering a disruptive technology in a growing industry. $DOCU. Ideally, a company has all three of these characteristics, like $NFLX. 3. Finally, I want a company with rapid revenue growth, greater than 25%, opportunities abroad, and a loyal customer base/customers that love it. Essentially, I want a company with an open runway for growth. After potential, I look at the company's financial statements. Ideally, I am looking for a company with lots of cash, little or no debt, and strong, positive free cash flow. Example, $AAPL, tons of cash, little debt, and positive free cash flow. In addition, the best companies have high rates of return on equity, greater than 20%, growing free cash flow, and growing earnings per share. However, many high-growth companies lack these features until they are more mature. Look at $AMZN growth. So this is not a deal breaker. Next, I look at the company's customer acquisition. I look to see, 1. If they easily acquire customers or if they have high sales and marketing costs, and 2. If their customers will continue to purchase their products, even in bad times, like dollar-cost customers would. Next comes the company management and culture. The best companies are founder-led, $AMZN, have high levels of insider ownership, $SSTI, have great CEO ratings on Glassdoor.com, $MDB, and have great employment ratings on Glassdoor.com, $Hubs. When a company does not have good Glassdoor ratings, it gives me serious pause, even if I like the company otherwise, $CHWY or $4. I want a company with a management and culture that I'm comfortable putting my money behind. Finally, I look at the stock's performance. I want a stock that has beaten the market over the last couple of years, has shareholder-friendly actions, and consistently beats expectations. These metrics can be harder to track for a company that recently initial public offer. There are also some factors that can negatively impact my perception of a company. 1. Customer concentration. When a company's revenue and continued success is largely tied to a few key customers, don't want anything over 10%. Although many young companies have this and eventually grow out of it. Examples, $SSTI or $ever. 2. Market loser. Companies that have continuously lost to the market over time typically don't make very good growth investments. unless there is a compelling reason that they will turn their performance around. $JMIA or $Uber are examples of this. 3. Risk of disruption. As a long-term investor, I don't want to invest in companies whose industries have significant risk of disruption, $F or $XOM. 4. Outside control. I am also concerned by companies whose success is reliant on factors outside of their control, such as government spending or a strong economy in order to be successful. Example: $SSTI largely sells to cities right now, so they rely on government spending. 5. Antitrust concerns. $AAXN, $GOOG, $AMZN, etc. Not too worried about this one, as this typically demonstrates the company's strong moat and leadership, but it is just worth noting. 6. Fragile balance sheet. Lots of debt and little cash with unclear future. $JMIA, $CVNA. 7. Reliance on a single event. If a single patent rejection or lawsuit could entirely change my perception of the company, I don't want to be invested. Examples are young biotechs. 8. High levels of dilution. Not a deal breaker, but ideally not happening. $SQ, $Roku, $DOCU. 9. International risk. It is also worth noting when companies have significant currency risk, $STNE, or are based in a developing country or a country that has trade issues with the United States of America like $BABA or $PDD. 10. Growth by acquiring. Would prefer an innovative culture. The biggest factor, overall, however, my number one thing I look for in a company is recurring revenue. I want companies that keep customers coming back through subscriptions, $DDOG, or transactions, $MA. These companies often have strong pricing power and a defensible future. This framework for investing comes largely from lessons I have learned from. I cannot thank these wonderful investors enough for all the lessons that they have taught me and continue to teach me every day. Very insightful. Do you also pay attention to valuation charts? I pay attention to valuation some. $SHOP and $TSLA are very high right now, and I would never buy $NKLA right now. But the best companies are always overvalued like $AMZN or $NFLX. That's okay. I really like your approach and method. It is fairly robust and detailed in itself. I just want to know how you tackle the demon of valuation, as that was the only missing piece. Thanks. This is a great thread, especially for a young investor. One piece of advice: don't lose sight of expectations. Many companies with qualities you describe tend to surprise or exceed expectations over time, but some of the ones listed have very high expectations. Just be prepared for volume 2. Thank you for the advice, and I definitely agree. I am not actually invested in all of the companies listed, just some of them, and I am only investing enough money so that I am comfortable with some volatility. Good to know. Seems like you're getting started the right way. Subscribe to get more.